All right, let's jump right in. We're going to follow a fascinating 20-year experiment with two investors, Jake and Marcus. One decides to buy a rental property, the other puts his money in index funds. Now, here's the thing. They both think they made the smarter choice. And, well, they're both kind of wrong. See, one of them completely forgot to count the hours, and the other one, he forgot to count the zeros.
Okay, so let's break this down. We've got Jake, who goes for the tangible route, a physical property you can see and touch. Then there's Marcus, who goes digital, investing in the broad stock market. We're going to follow their two very, very different journeys to see which path actually builds more wealth over 2 decades. Now, to make this a fair fight, we're starting our guys from the exact same place. I mean, identical. Same savings, same salary. The only thing that's different is where they decide to put their money. So this is really a pure test of investment strategy.
So, Jake decides to buy a rental property. He takes his entire savings and uses it as a down payment. And just like that, he controls a $250,000 asset with just 50 grand. I mean, that's the famous power of leverage, and it's a huge part of his game plan.
And right out of the gate, Jake feels like he's winning. He gets a tenant in there, and after the mortgage is paid, he's looking at a $470 surplus every single month. On paper, this feels like an absolute home run. But is it really the whole story? Marcus, on the other hand, takes a completely different path. He puts his $50,000 into a super simple index fund that basically tracks the whole stock market. He even sets up an automatic $300 monthly contribution, and then pretty much just forgets about it. No tenants, no leaky faucets, no leverage. That $470 a month for Jake, it looks great, doesn't it? It's the kind of number you brag about. But here's the thing, that number is kind of a mirage, because it completely ignores the relentless, unavoidable costs of owning a physical thing in the real world. So here's the reality check. That tidy little surplus, it gets eaten alive. You've got property taxes, insurance, and then bam, the water heater dies, the roof starts leaking, and don't even get me started on vacancy, that silent killer of cash flow when a tenant moves out and you're stuck paying for everything.
And beyond just the money, there's the cost of time and stress. Jake's investment is basically a part-time job he's not getting paid for. One minute he's a property manager, the next he's a repair coordinator, all while trying to do his actual day job.
Meanwhile, what's a week in Marcus's life look like? Well, it looks like nothing. It's empty. His investment requires exactly 0 hours of his time. No late-night calls, no emergencies, no screening applicants. His money is working for him, so he doesn't have to. So how do these wildly different paths actually play out? Let's fast forward 10 years. What we find is honestly kind of shocking. After a full decade, their net worth is almost identical. Both Jake and Marcus are sitting on right around $170,000. But let's look at how they got there, because that's the crucial part. Jake hit that number by pouring hundreds of hours of his life into this thing, taking on a massive mortgage, and putting all his financial eggs into one single basket, one house in one neighborhood. And Marcus, he got to the very same number by, well, doing nothing. He spent 0 hours, took on 0 debt, and his risk was spread so thin across thousands of companies around the world. I mean, it's the same destination, but a completely different journey. All right, time for the final verdict. Let's fast forward another decade to the 20-year mark. And the result, again, it's astonishingly close. Both Jake's equity in his house and Marcus's stock portfolio have grown to land them somewhere between $400,000 and $500,000. On paper, it looks like a tie. But this is the real story of our experiment. You have to look beyond the final net worth. That's basically a wash. The real story is in every other line item. The hundreds of hours spent, the high stress, the massive debt. The cost of Jake's journey was just dramatically higher. And think about it. Marcus's wealth is liquid. He can sell tomorrow. Jake's is all tied up in a single building. But hold on. This isn't some simple story where stocks are good, real estate is bad. That's way too easy. Marcus's hands-off approach has its own set of serious, stomach-churning risks that you absolutely cannot ignore. I mean, Marcus had to live through brutal market crashes, like back in 2008 when the market just fell off a cliff, down 37%. He had to fight that very human, very powerful urge to panic and sell at the absolute worst possible time. Plus, he never got a monthly rent check, and he missed out on some major tax breaks. And that's where Jake's strategy for all its headaches really has some unique power. Leverage let him control a huge asset. Tax deductions for depreciation, which is basically a write-off for wear and tear, helped shelter his income. These are powerful tools Marcus just didn't have access to. So after seeing the numbers, the stress, the risks, and the rewards on both sides, we come right back to where we started. After 20 years, who really made the smarter choice? Jake or Marcus?
Well, the answer is that asking which is better is actually the wrong question. The real trap isn't the asset you pick. The trap is picking one based on a gut feeling or what you heard from a friend without accounting for all the costs, especially the hidden ones, like your own time and your own sanity.
So what's the ultimate takeaway from all this? The best investment isn't a stock or a house. It's the one you truly understand. The costs, the risks, the whole shebang. The next time you hear an investment pitch, just ask yourself, what are they leaving out? Because the right answer for you is always the one that includes everything.